Good morning. Hang on, trying to get everything set up. All right, hang on, almost there. This YouTube process is a little quirky. All right, very close to being done. Hang on with me. Hang on. Be cool. All right, so anyways, good morning, everybody. Today is a Wednesday, Wednesday, May 16th, 2018. Let me remind you that trading Forex is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please always stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. By the way, my name is Wayne McDonald. I am the Chief FX Market Strategist. Nice to meet you. For TradersWay.com. We're a boutique Forex trading firm, and I would like to earn your loyalty and respect over the next 90 minutes as I do this webinar. I'm going to do that by covering technical and fundamental analysis for the day, maybe cover some trader psychology stuff, but basically you're the boss, and I'm a humble currency analyst, and we'll do whatever you want to do in regards to Forex. We'll cover the dollar pairs, we'll cover the yen pairs, we'll cover gold and oil. And that's usually enough for the last for an hour and a half. Yeah, look at euro. Okay, well, we'll look at euro. All right, so if you could, please visit tradersway.com and open up a demo account today. I think I'm going to do a special event in the next couple of weeks just for those that are holding those accounts. So please do that. Also, if you could subscribe on YouTube, and the reason I say that is that when I do these live events, they'll notify you. Just make sure you click on the little bell. And if you are getting any value out of today's webinar, just, you know, that whole kind of thing. It's important. Look, it's important to YouTube. So it takes you a millisecond. It takes you basically no effort to do that, but it is important. So if you could, I'd appreciate that. All right. Well, without further ado, let's dive into the charts. This is where we left yesterday. This is USD CAD. We had some Canadian news, and it started to skyrocket. And what we had talked about before the news is where the obvious levels of support and resistance were, and we had this discussion of being in control of your trading, have a trade plan in advance, not being reactionary to what's happening in the mega short term on the charts, but instead, you know, trading your bias and all that kind of stuff. You can't control the market, but you certainly can trade your behavior, or sorry, control your behavior. So going back to just simply where we left off, on this pair, I had marked resistance, 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 resistance. Okay, going back weeks. Where's those days? No, weeks. Okay. And, you know, again, here's recent resistance. We marked all that out. We also have, so we called that price resistance. And then you see this dotted line, and we called that market resistance. And we said, look, amateurs are going to buy this giant green candle. Because remember, on a smaller time frame, 4 hours, it's just going to be like a rocket ship, right? So let's go to a 15-minute chart. So here it was. The news came out and was just up and up and up. And we talked about, look, if you're in control of your behavior, if you actually have a trade plan, it'd be very foolish for you to buy it if you're a bull, because we're very, very close to what I think is obvious resistance. So being a bull in here, trading long simply because of this news event that created this volatility is pretty short term. Like, the only way you could do it would be to scalp it. And even then, you're going to have to ignore this obvious resistance. Like, if you're so aggressive, why didn't you buy it down here on support, right? Why did you wait for the news and buy it way up here near this gray zone? So to me, it was just like foolish to even be trading it, I think, is the message that you got. That you wouldn't want to buy it, and selling it is pretty aggressive, but you could be a bear. And so the next part of the message was, if you were a bear and you expected it to go from bullish to bearish somewhere around this gray zone, what kind of price action would you look for to be a bear? And here we go. We got a 5A cross, and then down, down, down. But even after that, mediocrity. Is that really what you want? Like, you're going to tell your potential investors, like, well, I like to look for mediocrity and then start trading. So, but I thought a pretty good lesson where we went through step by step by step by step how to identify that as resistance, and a pretty lousy place to buy, even if you see giant green candles. And the other thing we discerned was there's a difference between news and fundamentals. News are sort of risk events, volatility events. Fundamentals is the trend of these events in the context of central banking policy, which modern central banking policy is quite transparent. They actually tell you what they think now. So you don't need to freak out because the news, was volatile or something. That's just a volatile. It's for many opportunities, but for many it's also a risk event. So I'd rather you be aggressive as a bull down at support, right? I mean, what would you teach your children? Wait for it to get to resistance and then get aggressive, then start buying, right? Why, if you were so bullish on this pair, then why didn't you buy in a bullish zone? Why didn't you buy at support? And of course, the answer is, well, you weren't bullish until after it turned bullish, right? You didn't turn bullish until after the news event, until it was way up here. Hey, good morning, everybody, by the way. Does that make sense? If you're going to be bullish, why not be bullish at support? That's when you're supposed to be aggressive. And then look at this. There's a pretty obvious buying opportunity before the news. Okay. So anyways, cool, right? It held. I would say that held. Did it give you a great opportunity to be a bear? No. Is it bearish yet? No, that's not really what we were talking about. But if it did turn bearish, you might as well try to get the full Monty here. You're already in. Right? And if you broke even, who cares? But if you were able to actually trade the change in trend, you should get paid. Remember, there's no point in trading in Forex unless you get paid. And 15, 20, 30, 40, 50 pips, you can't live on in the long run. So once in a while, you're going to have to get paid. Right? You can't bunt every time you're at bat. Yep, sold it yesterday as a scalp. Yeah, okay, that's fine. Yeah, as I said, yeah. You pick up some pips. But, ideally there's more to that. But as far as the scalp, though, I think the more important thing, I mean, the scalp is the scalp, right? So you pick up some pips, which is great. But the big message here is just because there's green candles, many newer traders that are less experienced, they see that and they say to themselves, oh, I guess the market's bullish now. And they start buying at the exact same or near the period where professionals are actually getting ready to exit. And to me, this was a pretty obvious place, right? So hopefully lesson learned. Because remember, we were talking about it down here and not up in here. Bum 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 bum. What is this? We got a daily, huh? So there's a daily long swing. If you're simply a day trader, let's go on to like a 15-minute chart, right? If you're a bullish day trader, this is your trade plan today. Okay. If you want some dollar strength, or US dollar strength, Okay. So if you're going to follow on that news event, right? So here's one way of looking at it, right? I'd rather you do that if you happen to be a bull. Now, again, do I know if it's going to go up? No. But this volatility in the news, instead of chasing that on a 1-minute chart and a 5-minute chart, because, you know, I don't want a situation for you as a professional trader where you're in trades for, you know, 5-10 minutes and you're like, oh, well, I lost money. You're like, lost money? You were in it for 10 minutes. Yeah, 10 minutes. Now, I love that. I love that trading, right? But I'm just saying, as one day you want to work toward being a portfolio manager and you just can't lose money in 10 minutes, because what happens is it's the volatility that makes you unlucky. So even if you had the right long-term trend, you can get unlucky and lose money. And over the long period, what you would like to do as a professional trader is remove the luck and the unluck as well, the bad luck and the good luck. You want to remove that luck as much as possible and just have solid trade plans. So the shorter time frame, a little bit more, I wouldn't say, like, I'm not trying to discount scalping because it's valid. I like scalping. So there's no real luck involved in scalping, right? So that gives a lot of credit to the scalpers. But you can be unlucky, and we want to remove that. Okay. So anyways, there's our little day trade. Okay. And what would you do if you were a bear? If bulls took it north here? Yeah, maybe down, huh? Gee whiz. I guess I had that as an arrow. Anyways, let me kill that. Okay. Little day trade. Cool. By the way, guys, thank you for the likes. I appreciate that. It tells me that I'm covering the right kind of topics. Let's move on to a different currency pair. How much would you suggest using I'm sure there, like Jacques, there are EAs, right? I would place them. Yeah, that's fine. Totally fine. So, like, when I taught my dad how to trade Forex, he would like, he got athletic sweatbands for his wrists, right? And he would like tape his phone or something to his wrist. So while he was sleeping at night, his phone would vibrate, wake him up, and they're like, oh my God, I got to go trade. So, sure. Yeah, it's a great idea, Jacques. I typically just float around my charts all day, every day, 24 hours a day. You know, that's kind of my way. Okay. But yeah, what you're asking here, you know, you would place them near buy and sell zones, and yeah, perfect. Yeah, absolutely awesome. Cool. So yesterday we were talking about the potential for an inverse head and shoulders forming. I surmised that it might take place somewhere around this left shoulder. It came down, folded in some weekly pivots, right? Double bottomed, higher high, higher low. So now on the smaller time frames, let's go to like a 15-minute chart. Is anyone going to hammock this? So I have to draw another one now. This would be one bottom. Lots of lines, you're going to get confused, right? Double bottom. higher high. So now you should fib this, right? So I'll just pick a line randomly, 618. Doesn't matter, it could be 382, it could be 50%, but whatever. Is anyone going to play that? Yeah? What do you think? Aussie dollar, that you're going to need US dollar weakness. You guess so. Well, don't guess so. You know, write down multiple reasons why you think that might turn bullish. Well, one, you might say when you back out here and include 3 or 4 weeks of price data, you think there might be a potential for an inverse head and shoulders. Okay? That could be one. So then when you zoom in on the smaller time frame, kind of where you want to see the right shoulder forming, you see a double bottom higher high. Does that give you permission, under your rules of engagement, to risk a trade somewhere in what I call the buy zone? That's the buy zone. And the bottom here. And of course, you might put your stop here, but you might as well put your stop there. So how many pips is that? And are you willing to risk that many pips for whatever reward? So just plan it out. Brooke's already on the double bottom. Very nice. Did you use the pivot for that? If so, you'll notice it's an S pivot, so it's an R target. That gets you to 76. So you're long at 74.5, and you're going for 76. And that's a nice little, it's actually an inside week. So if you can get that, it's not an exciting trade, but I think what it ends up doing, Brooke, is it sets up next week's trade to be awesome. So I might even be so bold to leave my stop at break even though I'm up 150, and see if I can get some sort of monthly swing out of that. And the monthly swing now is monthly S to monthly R. Even though you're in at a weekly R, a S going for a weekly R, I might just go for the monthly R just for fun. And that's 77. Maybe. I might not do that, thinking about it now. Maybe I wouldn't do that. Well, we'll see when we get there, right? Dan says Aussie jobs coming up and they're not expecting great figures. Yeah, that's true. But what's the trend? I mean, it's not likely to be shocking. Okay? So it could be less bad, Dan. It could be bad. It could be disappointing, but it could be less disappointing, which could be really good. So when you do economics, and I don't really have a great drawing tool on YouTube, but there's right? There's like inflation or jobs or whatever data that we're trading. And then there's expectations, and it's usually denoted with a little asterisk. So you could have like future GDP versus actual GDP, future Aussie jobs versus actual Aussie jobs, or I shouldn't say future, well, expected, right? So let's say everybody thinks that the Aussie jobs report is going to be terrible. But what if it's like less terrible than everyone thought? Then that's actually good. You see what I mean? So as long as your stop's at break even, you've done your job correct, I think. I'd like to go into an Aussie jobs report with a stop at break even and go hero or zero. Okay. Remember, if you have like 5 trades set up, each one is worth a potential of, let's say, at least 150 pips. You're going to have weeks where none of them hit. You break even on everything. And for a lot of new traders, that's actually a good week, right? Like, how did you do? Well, I made like 10 trades and lost 500 pips. Yeah. So some weeks you'll break even on everything, right? But in other weeks, and the real difference isn't really your trading, it's just the market conditions change towards your bias. So there will be other weeks where you're in 5 trades that are worth that many, and you walk away with 500 pips or 1,000 pips for the week, which is for most people a really good month. Well, how do you make those kinds of pips per month? Well, you have to be in those trades, right? So it could be one of these situations where, at least this is when I'm swing trading or portfolio trading, like when we're in certain parts of the year, for example, my mentality is focused on the bigger trades, the big light trades. I look at this and I say to myself, if I get in it, is it worth staying in? Can I reasonably expect a couple hundred pips? And if the answer is yes, especially without the risk of like losing big money, if I can get in this, now it's a hammock trade, so I've defined my actual bottom versus this actual bottom. So I say, well, I'm only risking 30, but I'm going for 200. And the next part is, well, with Aussie jobs coming up, between now and then, in the next 12 hours, let's say, will I have a reasonable opportunity to at least move my stop to break even? Can I remove the 30 pips worth of risk? Do I expect it to go up enough for me to move my stop? And if the answer is yeah, probably, then I get a free shot at Aussie jobs. You see that? I'm risking the opportunity cost of just like, look, if I move my stop to break even, I'm probably up 30 pips. So I'm giving up the 30 pips for the chance of 150 to 200 is the thought. Now, if the market reacts to the Aussie jobs report in a way that makes the Aussie USD go up, I get paid. But it's a home run. Right? It's boom, nailed it. I get my triple-digit profit. Now, I'm giving up the 30 pips, but how many trades, if you're making 30 pips, how many trades do you need to make 100 or 150? And you might say 5, but that's not true because you're going to have some losers in there, right? So it could be, let's say 8 trades. You have to make 8 smaller trades to get the 150, where I'm just jammed at break even. And if I'm so lucky as the market reacts my way, the volatility goes my way, then I make the money. And if you remember the USD CAD trade I showed you, I'm like, if you're so aggressive, why didn't you buy it at support? Well, now I'm kind of being aggressive, right? I'm like, well, if this is an inverse head and shoulders, you would want to buy it here. Now I got my double bottom higher high, so maybe I should be aggressive here and buy it before Aussie jobs report. And then Aussie jobs report comes out and the market pops, and we get a giant green candle, and then all the inexperienced traders are buying it way up here, where I was aggressive too, but I wasn't aggressive after the fact, reacting, paying higher spreads, trading in the higher volatility. I was aggressive when it was calm and cheap and boring and such, and here I am trading a stupid double bottom at a support pivot, right? It's boring, but it might be worth it. And then I move my stop to break even, let's say, after London close, and we'll just see how Aussie jobs goes. I might wake up and say, oh, boom, 100 pips, right? Right? It'd actually be more than that, I would expect. But, well, that's really the next one. It's about 100 pips, not quite. But it might be up here, right? But I might be in it all week. I may be in it all next week. And now I took a reasonable scalp with a reasonable reversal pattern in a reasonable reversal pattern. Remember, this is a reversal pattern inside of a reversal pattern. So this might be the opportunity where I'm risking 30. Then tonight I move my stop to break even. Then tomorrow I get paid, but it might just keep going up. It might keep going up. It might be a change of trend. And, you know, I'm not just, it might be 300, it might be 500. I sound like Don Lepre, right? It could be 1,000,000 pips. Yeah. But I'm just trying to share a different thought process of setting up trades. That's all. Okay. But you watch. If it goes my way, you'll see people will be buying it way up here at 75.50. I'm like, 75.50? Why don't you buy it at 74.50, bro? Right? So anyways. Right? Trying to get you to think big. Yeah, yeah, and I love the news, how they always come up, Joe. Joe says, you know, then you see all the smart guys on TV after the fact talking about how they expected the dollar to weaken. And very often they'll say, it's something silly is usually what it ends up being, right? Some silly little reason that explains why. Okay. So how am I doing on the swing? Oil swing. Caught on the R. You notice that? Caught on the R pivot. '71's our top. Remember, the potential is, basically 73, 72, 79. We're pretty close. Forex trading is a gold mine. And it's open for everyone. I wonder why people are ignoring it. Are people ignoring Forex? Kiwi dollar, very strong. Okay, we can go over there. We'll come back to oil if you want. Kiwi dollar. Yeah, let's do it. Let's do it. For sure, eh? Okay, I'll cover the Kiwi dollar, but you got to give me the like. Huh? I'll spend a couple of minutes on Kiwi dollar. You gotta spend the quarter of 1 second on the little thumbs up thingamabob. Okay, so we have a question here. Kiwi dollar, we're on the buy zone. Okay. So the very strong support. Can you analyze, please? Expecting at least some recovery. Okay. Well, here's the interesting thing, right? Let's back up. What was my trade plan last month? Let me kill this and kill that. Isn't that interesting? Do you guys remember doing this? Okay. Look at this target and everything. So I can see that I've drawn this for you. Okay. Now what might blow your mind is, I don't remember this exactly to the second, but I'm pretty sure I drew the triangle before price went up. All I did was look at the 618 Fibonacci retracement of the lower low. I think I was teaching you how to price action trade. So I'm like, well, that would create a retracement. Let's make it 618 and all the way down. This line is typically a target. So all that kind of stuff. Yeah, it worked out very well, right? But what's the most important part of that trade plan? Because remember, we don't know what's happening. It looked like this when we drew it. Cool, thank you, Raymond. Raymond says, yes, I did draw it first. Okay. What's the most important part of this? Where did the upward movement reverse? Yeah, but what I'm talking about is this pivot. The red zone means get out. Okay. You see how it started to the exact pip? The flattening yield curve affects USD. Yeah, okay. Let me finish this thought process, and then we can do yield curve analysis if you want. Okay. So this is where you would expect bulls to take profit. How do you feel about suddenly a lower low relative to this low? Well, that's what we were talking about then. We were in this situation when I drew the triangle. I'm like, look at this low. Look at this low relative to this low. So if you were a bear, you certainly would look to start selling the lower low. That predicts a lower high. And the fact that this kicked off exactly at the pivot gives you confidence to look for the sell. And another way of looking at it is all these bulls are nervous they're going to give up profits, so they're jamming their stops and they're freaking out. Okay? So you're hunting their stops. And that's a particular mindset that I like to have near the end of the month or near the end of the week. Okay? So anyways, I bring this up. Okay? You see lower high, lower low again. Very basic price action stuff. Remember, I always tell you look left, predict right. Right? Look left, short right. Very basic price action stuff. Cool. Down, 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 down. And it really goes well. Okay. This means stop selling, by the way, this green zone. You're like, Wayne, but it kept falling. Yeah. Okay, so new pivots, this is where you use moving averages. Doesn't mean like this is a good trading. Oops. Even though it's falling, or let's talk about this. New pivots here. This is M2. Is M2 a good selling pivot? No. So what do you use in the situation that we're in here? You use moving averages. Well, on the 1 hour, they're lame. You have to probably go to the 4 hour or daily to look for your moving averages. But is there another way of trading this? Yeah, trapping it. Okay. And let it break out. How do I teach you to trade a breakout? How do I teach you to trade a breakout? Trap it in the range. Well, so Freddie says, be surprised when it breaks out. Well, so you're more describing how you should trade when you're in the range. Okay, that's range trading. So when you're swinging like that, I'm not really asking you to buy here and sell here and buy here. That's not what I mean. I'm still talking about the downward movement. Okay. You let it break. Thank you. Shaw's got it. You wait for the break and you wait for it to retrace. Okay. So the long-term move is still bearish. This is not a bullish entry anywhere using pivot points. Okay. But you still don't necessarily want to sell it up in here. You want it to, because you don't know, it's 50-50 on this chart anyways. Maybe on a higher time frame it's different. But what you do want to do is look for something like this, and then you continue. Because these moving averages on this time frame are not helpful. So maybe on a 4-hour they're helpful, but I don't want to go there quite yet. All right, so anyways, let me kind of like that. All right, and then what? Right, the lower low, you look left, drag this out somewhere in there. That's your guide. Just because it went above doesn't mean to not sell it. If you're in this area now, guys, if you're above this area, that definitely means stop selling it. This first one is more of a guide. So when you've made a lower low, and I mean this is what you're doing when you're down here, is you're preparing to sell. Do you sell a support? No. Do you sell high? Yes. Therefore you needed a retracement, right? Yes. Where is it going to retrace to? Well, my general guide based on a basic price action trading is I draw this over and over and over and over and over again. I look left, I find the old support, I drag it across, right? And I say, well, somewhere in there, I kind of want to sell. I might sell a little earlier, I might sell a little high, but I'm looking for the pattern anyway. So, where's the 5A cross? Way up here. Is it perfect? No, but it ends up working, right? So you do something like this. You prefer to sell somewhere, the most ideal places to sell is like the 3A2 or the 618, which is this or this, okay? So you're kind of thinking all of that. So you might have sold the 618. If you did, you put your stop up here and it worked out. If you used a different trigger like a 5A cross, you sold the 5A cross here, put the stop above there, and it worked out. Either way, that's all price action, right? And now, lo and behold, now we reverse this whole process, okay? Now we're here. What happened when we were at resistance? What did we do when we were at the opposite of this? When we found we hit a monthly pivot, a particular monthly pivot, the one that says take profit. We saw one that said take profit if you're a bull. It hit it to the pip and respected it to the pip. What happened to that market? What can we learn from the past? Is this valuable information? It's not even like a similar situation. I mean, it's the same currency pair and all that kind of stuff. It's probably the same people trading. If these people were long, what did they do? And then if they went short, what would they do again? I mean, you have to predict, right? So now what? You have a choice. I don't know what's going to happen here. You don't know what is going to happen here, okay? Should you sell this? It's been bearish for weeks now. Should you sell this? How many people, this has been bearish for weeks. How many people want to sell this now? Come on, guys. No? Cool. Does this mean that it's going to go up? Does this mean it's going to reverse like it did here? See, we don't know. It doesn't mean anything except bears should take profit. Bears should not sell. So if you're not in it and you're a bear, this is a terrible place to sell. If you're a bear and you sold weeks ago, it's a fantastic place to take profit. So that's all we've learned, right? Now you have to take that information, okay? If you want to go along, what do you want to see here? What's going to make the decision for you? And you should start planning this. So in a situation like this, I often give you a pattern like this to, in a situation like this, I often ask you, what do you need to look for before you buy this? And the answer is reversal pattern. And they'll say, well, what reversal pattern are you looking for? And a lot of people will say double bottom, then I'll offer a 1, 2, 3 reversal, which is a double bottom with a higher high, higher low. But you're thinking about this in advance. And in my book, I call it, trading with your mind's eye. You see this before it's happened. You might even see it when it's up here. You're like, ooh, when it gets down to this reversal pivot zone, the pivot profit zone, I would like to see a 1, 2, 3 reversal pattern. And then I would like to buy against the existing trend because I believe lots of bears are going to take profit here. And that's a trade plan, but you see it with your mind's eye. And then it's happening, and you're like, well, it respected that bottom. I wonder if it'll double bottom. At some point, you're like, I think it's double bottom. I think it's made a higher high. Okay. Do we know if it's going to go up? No. Is there a trading opportunity there if you're a bull? Yeah, for sure, eh? So just like we discussed in the other scenario, you look for somewhere between the 382 and 618, right? And what should that predict? Well, the 50% predicts a 1382. So it actually ended up being this. Okay. So now that it's happened or is happening, if you traded this 50% retracement, which is just a standard 1, 2, 3 scenario, then your 50% predicts the 1382. That's why I drew it this way. And then it'll probably retrace again. Where's it going to retrace to? It's going to use this old, right? It's going to use the old resistance that becomes support. And your new trade plan is going to be like that. So you're going to have to fib that now. And that's also a 50%. So that's going to predict a 1382. And too many fibs. 1382 is there. Okay. And there's your next 2 or 3 days worth of trading. Of course. Right, Adam? You wouldn't want it above. It could be here, it could be here, it could be here. I mean, it's just a judgment call. The only thing that changes is your lot size. Okay. Now, many years ago, there was someone that came to my webinars every day from years and years and years. And he ran into a problem of having inconsistent results. He was really, really good most of the time, and then he'd have a bad period and all his success would go away. So I said, well, what you need is consistency. And he agreed with that. And I said, trade this pattern 100 times in a row, nothing else. Spend your whole day, every day, on any currency pair you want. Doesn't matter to me. Look for, right, hardcore support or hardcore resistance. Look for double bottoms or double tops at that point. Let it make a higher high or a higher low relative to the double bottom and double top. Then use a Fibonacci study to buy the dip or sell the rally. Right? So his trade would be in here. And then let it run. I said do it 100 times in a row, trading no other situation, trading no other scenario. And by definition, you will be consistent. That is advice that you could take. Right? In that situation, you might, oops, I guess I turned that off, but you might have been short at the top and all that kind of stuff at the bottom. And does it always work? Well, of course not. But like, let's go back to this scenario. Didn't really work. No real double bottom. Maybe this one. I guess if we were really if we're going to squint, maybe you traded this one. So you're at the obvious support level. Okay. None of these actually hit your support. So this one hits support, rallies up significantly. And you're like, oh, but it hasn't proven to you that it's not going to continue down. You need the double bottom. So here you go, and you say, oh, well, if there's a significant move here, right? Well, then you're going to buy it. So there might be this one. That might not be convincing enough for you. Okay? Right? So that you might have waited for this one, and you may not have gotten it. Right? Because it just, you didn't get your pullback. So it's one of these scenarios where you're like, oh man, but that's why you need consistency in your trading. It didn't work out. It still went up, but that's not your job. Your job is to say, well, I'm waiting for the retracement because I'm only trading double bottoms with 1, 2, 3s, right? So your job is to like wait for it to at least do this. You cannot go in before that, right? So you're like, yeah, it didn't work out. But look at, you avoided that situation, right? And that's the benefit of really structuring your trading and removing sort of trading on a whim. Oh, look at this and look at that, or I wonder what I'm going to do today. All of those are not helpful characteristics. I wonder what I'm going to do today tells me that you're going to lose money. Right? You can't do it like that. It's like going to Vegas with $5,000 in your pocket and you're gonna gamble for fun. So how do you leave Vegas with a lot of money in your pocket? You're like, oh man, I'm gonna go to the tables. I don't know, I'm gonna do some blackjack, and I'd like to do some Texas Hold'em. That'd be cool, and do some roulette, and we'll do some we'll do the horse racing thing, and then I'll do some slot machines. It's going to be fun. How much money are you going to have at the end of the vacation? Statistically, we don't know, right? But what are the statistics? You're going to lose every single penny, statistically speaking. Now, you might win a big, right? You might put a thing into the slot machine, boom, you win $100,000. But it's not likely. In fact, it's nearly impossible. Maybe you buy it's amazing to watch people, right? They buy like a $100 coin. Have you seen this? And they go into the slot machine and put it, and it's a giant slot machine, right? And they put it in the slot machine, and it takes two hands, and they pull the handle, and it goes chink, 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 nothing. You're like, what is that? The best way to get poor quickly. But people do this, right? So look, you cannot trade like Forex like it's fun. Like, oh, I wonder what's going to happen today. Oh, look at this. Oh, look at the Aussie jobs report. Ooh, look at the green candle. Let's jump in on that. It's not going to work, my friend. Yeah, that was fun. People do it. You know, the funny thing is, my personality changed in many ways when I became a Forex trader. And I used to go to all the Forex shows, and there was, every year I was in Vegas and stuff, and it was amazing as a Forex trader to walk through the casinos. And I just shake my head like, suckers, right? And someone else said, wow, they like the adrenaline and stuff. I'm like, yeah, well, how about leverage up your money 100 to 1 and start trading Forex, right? But after a while, even then Forex becomes, dare I say, mundane. It's a job. It's a career, It should be as exciting as putting labels on cans of peaches, right? You just walk into the pip factory and put your hours in and you get paid, right? And it's not fun. You don't show up with pop $5,000 into an account and see how it goes. We have to change that mentality. There has to be a mentality of professionalism. How about someone that goes to Vegas but has practiced 10,000 hours how to beat the dealer at blackjack? Nothing else. All they know is blackjack. And they put 10,000 hours of research and practice. That dude's going to get kicked out of the casino because he's making too much money. Right? And the government's going to tax you 50% because they're like, that's not fair. That guy makes his money too easy. So, I don't know. Go in it with the 10,000 hour mentality. And when you trade, you should expect to make money. When you pull the trigger, you should expect to make money. And when you have a losing trade, and that happens all the time, that's fine. You should say, holy crap, that's weird. Who bought that? What a dumb trade. Wow, all right, so the market's wrong. It's not me, right? If you buy at support after a double bottom and then it collapses, makes a new lower low, somebody sold it at a double bottom, right? If you have obvious support, so I'm going to trust that you can see things like pivot points. Like, look, a cluster of monthly and weekly pivot points. Is that support? Yes, that's support. Great. So what happens now if it collapses and it falls through here, here, and here? If you buy this after a double bottom, after a higher high, and you buy the higher low, is that a good trade, yes or no? Yes. You can't argue that. It's factual. Is that a good trade? A double bottom at double levels of support, and you trade a retracement? So let me just draw it again. Okay. Let's just be definitional here. That's subjective. There isn't like Wayne says this is good. Wayne says that's bad. No, it's just, right? When the dealer flops a 9, all it does is it changes your odds based on what's in your hand, based on what else is known to be on the table, right? What else you think is on the table, what you think is left in the deck, what the dealer is showing. So a 9 comes up and you're like, 62% chance of failure. Oh, fold, or whatever it is, right? 82% chance of winning. Ooh, all in, right? It just changes the odds. So anyways, is this support, yes or no? It's weekly support. It's monthly support. It is support. Yes, done. Has it made a higher high after respecting support? Yes, it has. All right. So now you wait for the Fibonacci retracement. Good. So let's say you buy here. Okay. This is now your entry. For you to lose money, think of it this way. For you to lose money, some moron is going to have to sell this. What kind of loser would sell at this cluster of support? That's how you want to lose money. Where if you lost money, you're like, well, take it, dude. You want to sell into that? Take it. I'm out. You want to be a bear in all that support? Great. It's all yours, man. Have it. But you don't make 19 other long trades and keep losing money, which is usually a great way to lose all your money, right? Keep buying this as it's falling. No. At the very least, stop. So if you're going to buy it, is it okay to consider buying it at a cluster of weekly and monthly support? That's monthly M1. That is the place monthly swing traders are supposed to take profit. And now we're at weekly M1. Well, that's where these weekly swing traders, right? As you guys already know, I covered this last week, that's a sell zone for bears. Well, whoever sold in that area is supposed to take profit here. Whoever sold it last month or earlier in this month, this is where they're supposed to take profit. You see what I mean? So if someone wants to sell into that, they can have it. But what's the likelihood people stop selling into that? Probably pretty high, right? So if you want to take advantage of their vulnerability, you can start hunting their stops, because you know there's stops here and here and here and here and here. But it is a counter trend trade, so it's not a good trade. It's a riskier trade if you're buying in an obvious downtrend. It's been down for weeks and you're buying it. It's not the world's greatest trade, but at least you're doing it at the exact right place and right price where you'd expect a reversal trade, because you're trading a reversal pattern. So you're expecting the trend to reverse. It's not an easy trade. Okay? But it is a trade. And if you understand all of that, then maybe it's worth the risk for you, right? So if the dealer throws down a 9 and you have an 82% chance of winning, are you for sure going to win? No. Are the odds better? Yeah, I mean, they're good, they're decent odds. So do you take the shot? Yeah, maybe take the shot. Do you fold your cards? Probably not. Do you double down and bet more? Well, that's your judgment call. Maybe in those situations, 82% chance winning. Yeah, maybe that's where you make your big money. All of that is judgment call. But what doesn't change is it's an 82% chance based on your analysis. Now, maybe you're wrong on the other cards. Maybe you're wrong with what cards you think are in the deck, all that kind of stuff. Maybe someone gets unbelievably lucky and another card comes up, and even though you had an 82% chance of winning, their card's better. So you have to manage your risk. Maybe you don't go in all in, but maybe you do. Okay? Okay. Human God wants Aussie yen. All right. Fine. Okay. So, by the way, if you learned anything on that, would you do the little likey thing? There's 100 and some odd people watching and only 50 likes. So it'd be nice if there was more. I'd appreciate that. And then we'll do Aussie. All right. Okay. Are you a bull or a bear? Human God. with ripped abs, I think that's what that is. I can't tell. It might be, I don't know what that is. Oh, a thumbs down. This sucks. Thank you, thumbs down person. They're like, this sucks. All right, cool. All right, bear, bear, bear. Great, you're in a sell zone. That's the sell zone. Okay. La 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 la. 2 people say it sucks. Thank you, sucky people. Yeah. Oh, now it's only 1. It sucks less. Cool. All right, so that's a sell zone if you're a bear. Let's break this down from a 4-hour to a 15. Oh, 3 sucks. Oh, 2 sucks. All right. Oh, shoot. Click the wrong button. All right, there we go. Let's back this up. Okay. So you're looking for bearishness, okay? You're sort of near the area you want to be short, but it's not great, so therefore you're not confident, okay? And what's happening now is freaking you out, and it should actually freak you out. These are not good conditions for you as a bear. But let me highlight that, like, that as a bear is how you should be interpreting things. So you wouldn't have shorted that, but you should have shorted this. Okay. The other one was unpredictable, or let's say more guesswork than anything. Okay. Should have shorted that. And your stop is above, obviously. And that the reason I say you're nervous or whatever, or not confident, is your stop is probably here. And what you're looking for right now is for this to roll over. So you wanted this to go down, and it actually hasn't happened, and that's the fearful part, right? So your confidence is waning for sure. But there's no real reason to get out unless you're afraid of having a minus 10 pip loss, which is funny. You should be happy to have a minus 10 pip loss. Okay, let me get rid of this. Oh, I lost my ellipses. Hang on. Okay. So that's kind of what you got on your mind right now. Now, the interesting thing is, on a weekly basis, you haven't entered a bullish buy zone. Okay? So you're nervous as can be, and that's okay. We are caught on this monthly central, so maybe this is just noise, but you are on a weekly basis in an okay sell zone. So you want to kind of remind yourself or give yourself the courage to be a bear. And I like to leave myself little mementos. I don't know how you'd want to draw this. It is flattening on you, so it's a little lame. Okay. And you want to tell yourself, as long as you're in this downward channel, things will be okay. Your stop's up here, so if it heads up, you'll lose a little bit of money. But if you're doing weekly analysis, you don't really expect it to go up until you're down here at 82, right? So that's the buy zone on the weekly basis. What's kind of messing this up is on a monthly basis, that's your buy zone. But don't you think if you were to fold in a weekly trade plan and a monthly trade plan, that you would still want this to come down as a bull to 82 and then pick it up in a bullish move? So I think if you're trying to be bearish, you're uncomfortable right now, but it's just be, can you be an Aussie bull? No. No, you cannot be, Katrina. Okay. So, you know, you got to just stay with it. If you made a good trade plan, you made a good trade plan. Okay. Looks like, you know, if you might have been up 30 or 40 pips. Now you're only up 10 or 15 pips. And well, stick it out. Okay. Remember that having a minus 10, minus 20, minus 30 pip loss is a good loss. Having a minus 2 pip loss perhaps is good. Having a plus 10 win is bad. Right? You don't want a career of small wins. So if you're in it and you got your stop at break even, it's uncomfortable, but let your trade plan out, kind of thing, if that makes sense. Okay, there are very decent sells in here. It would have been yesterday or the day before, so kind of doing it now is I wouldn't have sold after a double bottom and a significant rise. Okay, and of course bulls would be trying to play this another way, but it's not really a good bullish trade yet. But what would you do if you were a bull? Okay. Is it possible that bulls have that marked up? Bubba, it's way too early. By the way, I hope you're enjoying the rain. It's cooled off nicely. Yeah, it definitely should, right, Adam? And I typically don't use that job report to let it play out fundamentally. If it pops up and you know, and bulls get paid, I would take the profit. Okay. So anyways, if you're a bull now, guys, right, you're going to try to play the double bottom. Okay. Is it at a good logical place? It's not at a good logical place using weeklies or monthlies. Now you say, Wayne, well, what about it's great on a daily? I don't start daily and work my way up. I start monthly, weekly, and work my way down. So if I don't see it monthly, weekly, I'm not going to go daily and find a reason to buy it. If I wanted to buy it, I should have already bought it, right? It's like going shopping while you're hungry. You know, you'll say, well, it's not a weekly support or monthly support, but it's a daily support. No, I had that onion layer last, not first. But nonetheless, let's say you wanted to buy it. You're approximately 50% retracement after something that started in a very interesting place. It's not good on the monthly, but it's okay. It's not good. It's not a good bullish trade plan, but it's not a good bearish trade plan, to be frank, either, right? But okay, so you're bullish. You're treating it basically as a Fibonacci retracement. That's cool. Double bottom. You see this as a significant high. It's not really a higher high. Like if we were up here, right, it'd be better, but it's not. But if you were to buy it, where's the next level of obvious support? That's a definitional question, right? In your mind, what will be the reasonable support to take a shot? And you might play the monthly central pivot. Okay. Maybe you consider this a higher high relative to that high, or that, or whatever, or whatever. So you start busting this out, and you're like, yeah, 382 Fibonacci retracement, whatever. So your whole buy zone in your trade plan is actually this. Okay. Are you going to be right on this? Well, you know, it's very mediocre. So if you're right and it does go up, you're going to think yourself as a genius. If you sell sold this and it falls and you make money, you're going to think of yourself as a genius. But they're really both quite mediocre. I'm surprised you couldn't find something better to trade. Okay. Yeah, the monthly central. So if you were going to buy it, you'd play it that way. And you're like, oh, look at me, I bought the monthly central. But my analysis of the monthly pivot points right now is you're not really set up that well. Okay. Now, if you're talking about what happened several weeks ago, yeah, if you were long off of here, off of that, then that's a whole different ball game. But if you're going to treat this as basically, this has been a 382 fib retracement, and then you're taking a 50% of that, okay? But that needs to be in your trade plan. You need to be able to explain that. And then, of course, what I would like, if you were buying it off of a 382, off of this kind of move, I would like you to like be in it for the full Monty, of course, right? And that would be a minimum target of, let's say, 83.50-ish. But really, if you're taking that kind of shot, because we have to back out here, right? If you're going to take that kind of shot, every so often, somewhere in life, I want you to go for that one. Okay? Now, you guys probably are not looking at your charts this far back. Okay? You might be playing that out as support. Okay? And the interesting thing is now you trade this as your 1, 2, 3. So, which means by the time, let's move this. By the time summer is over, you are going to buy this retracement. So you might rally this up to like 85 and then have it drop all the way back to 82. And maybe in August you're buying it at 82. But anyways, you see how all the layers go in? Layer after layer after layer. Eternal Soul says a small win is good if necessary to trade out of a significant loss. Well, first of all, you're not allowed to have significant losses. Okay. So that's that. You're not allowed. How is that even possible? You should be in a situation where, like, that's not even possible. Right? When you put down a trade plan, and your stop is, let's say, 50 pips. It can't be any bigger than 50 pips. No, but any definition, Eternal Soul, any definition is of significance, it should be impossible. If you have a significant loss, it's because you didn't follow your rules of engagement. It should just, I mean, the way I've explained it in the past is you should define your worst case scenario ahead of time. Okay? Let's say minus 5 pips. Okay, well, right? Okay, well, let's go back. So your significant loss is 30 or 40 pips. See, yeah, so to me that's not a significant loss. So if you define that as significant because of the amount of money it is relative to your account size, then we have identified something fantastic. So cut your lot size. So for example, if I was mentoring you, Eternal Soul, the first thing I would do is have you trade with 100 pip stops. And you're like, 100 pip stops? Yeah, well, that's the whole point. And then we try you trading in a completely different fashion compared to compare it after the fact, right, to how you've been trading, and then we can decide the good, the bad, and the ugly of the comparison. And there'll always be something to learn from it. Yeah. But like, you know, you could even have 150 pip stops. Now, I wouldn't, it's a place to start. Like when you're learning how to like swing trade, for example, when you have big stops like that, it does force you to cut your lot size, but it also gives you an opportunity to learn like where in your trading with the smaller stops that you end up having trouble. Where you often get knocked out, you'll actually stay in, and then you can use that as a learning opportunity to find out like you don't really need 150 pip stops, but you could start there and then find out, well, wow, I'm trading a lot less, but after a couple of days, the trade that I originally made is now profitable. And then we can define, well, why is that not working when you're trading with 50 pip stop losses? Like, where are you actually pulling the trigger? Where is your entry points, right? Or where is it in your current process that you move your stop to break even or whatever? Where is it that you move your stop? This is a risk management type question, right? And we may find out that maybe your entries could be significantly improved, so you don't need 150 pip stops. Or we learn that it's a risk management issue. So when or what, when do you move your stop or what makes you move your stop might be the issue, and we can work on that. But for most amateur traders, they get knocked out so quickly, there's no way to analyze the subjective valuation, if you will, of the trading. So we can't really say, well, the trade you were in was worth 200 pips, but we never knew because we were only in it for 9 minutes and took 9 pips, right? There's no sort of, we can't compare it to anything. You were just in. Was it luck? Was it a good trade? Did you actually buy at support? Did the market reverse? Were you trading in the trend or against the trend? No, or all of it. And we can't analyze it. And don't we need to apply scientific methodology to your trading so you understand your strengths and weaknesses of your trading so that you can then specifically work on things like entry points or risk management to improve said trading? And if you're very inconsistent on top of all of that, then what is there to analyze? I'm long, I'm short, I'm bullish, I'm bearish, I'm 4 hour, I'm 4 minute, and all of a sudden, whoa, we can't figure things out. If you're going to be around 10 or 20 years from now, we need to break all of this type of information down into digestible bite sizes. So when I trade, I know if I'm a swing trader, monthly, weekly, or daily. When I trade, I know if I'm scalping. When I trade, I know I'm in it for the flow. If I trade, I know that I'm in it for the swap, right? And I know where the stops need to be based on my own trading and my own experience. But it's because I really have, with an engineer's mind or a business person's mind, I've ripped all my trading apart and formed it into a work of a scientific work of art. Whatever that means. But I know myself. There isn't much randomness to it. Yeah. Oh, well, you've done all that. Oh. All right, then cool. So if you've already done all that and you got that as part of your analysis of your trading, then that's the conclusion you've come to. Then that's that, right? I can't really comment on that. All right, cool. So that's that. I think I answered that. I hope I answered that. No, it sounds like maybe you're more day trading and stuff like that. Yeah. Still, to me, like 50 pips, Typically when I throw down, like let's put it this other way too, and then I'll stop commenting on risk management. But if I'm day trading and I use a 50 pip stop, I'm not going to get stopped out for minus 50 pips. There's no way. But I'll still use it. But I'm not going to get stopped out. See, you don't want to get stopped out, guys. What good is it to lose 10 pips? Oh, well, you know, I shorted, and then there's a big green candle, so I jumped out. Why are you so afraid of taking a loss? I'd be afraid of taking a 10 pip loss. It would make me look like I didn't know what was going on, and I was just throwing down trades, and now I'm panicking, and like, I'm down 10 pips. I got to get the hell out. Oh, my God, it's a loss. You sound frightened, in my opinion, right? So if I have a 50 pip trade, and I sell at support in a downtrend, I mean, that's what I'm supposed to do, right? No, sorry, not support. Okay, let's break it down. I'm supposed to look at a chart and say the trend long-term is down. And then I say, well, therefore I'm a seller. Therefore, I would like to sell high at resistance. Great. And it goes up to resistance, and it's obvious resistance. It's a weekly, a monthly, or whatever, a psych level, whatever. But it's a lower high in a downtrend at obvious resistance. And I sell there. I'm not going to lose money. That has to be the thought process. The only way I can lose money is if I'm completely wrong and the entire market is reversed. But that doesn't likely happen. I mean, right? I mean, if it's a downtrend, then it's not going to reverse. Unless you sold into monthly reversal pivots, and then, well, I'm not talking about that either. You analyze it and you say it's a downtrend, clearly a downtrend. Your analysis tells you it's going to continue down, so you're going to sell the high. You're going to sell the lower high. You're going to sell at resistance. You're not going to lose money unless something ridiculous happens. To take a 10 or 15 or 20 pip loss because your timing was off or there was a little bit of volatility around some news, but it still shouldn't make a higher high in a downtrend. So if I throw down a 50 pip stop loss, it's almost always, you know, decently above that next level of resistance. So now I got the current high and the likelihood of it not reversing on my side. Like, I'm not going to take a 50 pip loss. The odds are way against it, but I don't, God forbid I take a 10 pip loss and miss the opportunity to make 100 pips. Because if I'm selling in a downtrend, I'm going to make more than I'm risking. It's definitional. A downtrend will probably fall 100 pips, and I'm only risking 50, and even then I'm not likely to even take a 50 pip loss. So in reality, I'm only really probably risking 25 or 30, and I'm going to pick up at least 100. So it's like, I'm going to use the 50 pip stop, but I'm not going to get stopped out. And if I take the negative 50, it's going to be very rare, and only in situations where the whole dang market reversed. Well, then I should be out. Right? See, the worst thing you want is small wins and big losses. So you want medium-sized losses and big wins. I don't want a 9 pip winner, nor do I want a 9 pip loser. Because you can't make money making 9 pips or 19 pips even. Right? That yellow Lamborghini sitting in the garage doesn't come from 9 pip winners. That's what they, you know, guy on YouTube, hey, look at this. I got all the, I made $4,000 in 2 minutes using my MP4 account. Yeah, once. Oh yeah, sorry. Sorry. You get me on the soapbox. I apologize. I probably beat that horse to death. I apologize. I want you to get bigger wins. I want you to stay in your trades because you have good trade plans that are worth staying in. You understand that? Okay, got some gold. Yeah, James says good info. Yeah, we lost about 15 viewers. They're like, this guy's not going to tell me. When's he going to tell me to buy? Okay. So the predicted low for the month is 1,284, which I told you a long time ago. Well, obviously 15 or 16 days ago. We knew that to be the projected low. So if you were a bear, you should probably stop selling. And if you're a bull, you should probably start looking for double bottoms and higher highs, which ain't going to happen today. Probably won't even happen tomorrow. What should I do, Captain Fact? Should I sell? When's this guy gonna do? When's this guy gonna do it? Okay. Anyone taking that shot? That's a 4-hour chart. Scott teaching me to know it all. Beautiful, right? If you traded it up here. With a better shade, it's a lonely view. So WTI, we did all that. Let's look at your row. Sometimes it's like the quest for the Holy Grail. What is your name? Wayne McDonald. What is your quest? I want to make a lot of money trading Forex. What is your trade plan? Sell euro. No, wait. And then into the, what was it, the Valley of Death. Oh, look at this GDP. Anyways. All right, so what do you want to do, Haas? The bummer of this is it didn't set up well monthly or weekly. It's a real bummer. And that's that. It's just a real bummer. It didn't set up well either way. And you have to, over time, at least convince yourself that you're only supposed to do what you're supposed to do. Clearing up the charts a little bit, you can see it opened too bearish. Let me kind of move in. It opened up too bearish. You're supposed to use moving averages to trade this. In that scenario, 4-hour 5, 1-hour 21, and done. Any questions? Right? Just classic trading. Again, opened out of position based on monthly and weekly pivots. So you move to the medium time frames, either 1 hour or 4 hour, and you basically sell the 21. Okay, all right, everyone's got that? Okay, I know we've covered it a million times, but there it is again. What if Yeah, it's not really good in any scenario. Tradable, it's tradable mostly on the moving averages. Like I'm looking at it even from pivots and So go back to, classic FX boot camp. It feels like it's setting up for summer consolidation. Holy smokes, look at the time. I've gone too long today. I apologize, everyone. So I will do these webinars tomorrow. I hope you subscribe to the channel so that you're alerted and you can join us tomorrow. I hope you visit tradersway.com and open up at least a demo account. Thank you for all the effort that you put into your trading. I hope these webinars help. Again, I apologize that I went too long. I think maybe I started a little bit late though too, so maybe it all worked out. But anyways, I wish you the best. I want you to truly succeed, and I'll see you tomorrow. Thank you for being on my team.